What's up everybody, Gen X Dividend Investor here. In this video, I'll share lessons I've learned as someone whose dividends have covered all his family's expenses for the last 5 years, allowing me to retire while I was still in my 40s. I'll start by quickly going over my background and how I built my multi-million-dollar dividend portfolio from scratch, and then I'll show you my portfolio in Fidelity, and I'll share some lessons along the way. Feel free to jump ahead to my portfolio section if that's all you care about, but I suggest you not skip. So to begin with, I've been investing in the stock market for over 30 years, since I graduated college in the 1990s and got my first salaried job working as a programmer at a small company. I've never inherited any money or won a lottery, nor been given anything material, and in fact I started with a negative net worth when I got married to my wife. Feel free to watch my previous videos where I've shared my compensation and salary and such over time, so that you can understand that most of my returns came from compounding and investing over multiple decades, not from working at any crazy places like Google or Amazon or anything like that. I've lived within a budget and prioritized investing, and done things like forming investing clubs with friends, along with never quit investing, even when I lost big in the markets. I started doing social media as a fun way to document how I like to invest for my kids, once they're old enough to care. I've really enjoyed learning about making videos and running social media accounts, so this has become a fun hobby for me in retirement. I love getting to engage with people online, like this comment I got yesterday from a subscriber named Richard M, as it tees up some of the lessons I'm going to talk about. He mentioned having some serious health issues and was wondering if I thought it was safe to retire forever on my dividend portfolio, as his portfolio is about the same size. He said he was mostly invested in VU and VTI, along with some in SCHD and treasuries. So first I'd like to say that I'm sorry you've been dealing with all those health issues, and to answer your question, yes, I do feel it's safe to retire forever on a good dividend portfolio, as that's what I've done. And that ties into the first big lesson I want to share, which is that quality dividend investing works and is an awesome way to create truly passive income streams that can grow on their own. With each passing year, I feel more confident in this approach, and I get excited knowing that I'm building true generational wealth for my kids and beyond. I plan to pass my portfolio on to my kids, and I'm excited to know that I've not had to sell shares for cash like the classic 4% retirement rule. I get to keep my entire ownership in my companies, and they in turn send me some of the profits they make based on how much of the company I own. I find dividend growth investing a beautiful way to invest because each dollar that flows into your stocks immediately increases your income. Compare that to non-dividend stock investing, where you only benefit if the market decides to price your shares higher. With dividends, you're tangibly rewarded simply for owning the business, not for accurately buying low and selling high. Over time, those reinvested dividends compound like a snowball, steadily building a stream of passive income that can eventually cover living expenses and more. It transforms investing from a feeling of speculation into one of productive cash-flowing ownership, where rising payouts reflect the underlying strength of the companies you hold. Now, to be fair, if you know how to evaluate a company well and can identify great growth stocks, dividends or not, capital appreciation often outpaces the returns of dividends only. But for many investors, the consistency and reliability of a rising dividend stream provides both peace of mind and a tangible compounding reward for long-term patience. And that is another big lesson that I want to impart, which is that I've found dividend investing to be a much less stressful way to invest, which ties into what the subscriber was asking about it being safe, because I'd be super stressed if it wasn't safe. I mean, my dividends pay my mortgage. They pay for our medical insurance and our groceries. They even help pay for some of our relatives' bills who are struggling financially. Fortunately, we live in a fairly inexpensive place and our expenses are relatively low, other than my occasional spikes in healthcare costs and the travel we love to do. Our dividend portfolio has managed to hold up decently in both up and down markets, and I think many dividend investors actually appreciate when stocks crash. I mean, the lower the stock price, the more you can acquire things on the cheap, which is another lesson in itself. You see, the formula for dividend yield is the amount of dividends a company pays out per share per year divided by its current stock price. When stock price goes down, that means dividend yield goes up, which also means more income you gain per dollar you invest. It's kind of like if you're looking to buy a home and housing prices are falling, then you get excited. But if you're trying to sell a house during a crash, it can really stress you out, the same way it's stressful to have to sell shares for cash when they're down. But dividend investors are paid while they wait, letting the market stay low for as long as it needs to. That lets divvy investors focus more of their attention on their steadily growing income rather than just the daily gyrations in the market or in their portfolio. They just gotta guard against the allure of focusing only on yield over the quality that generates that yield. I mean, a sky-high yield might look tempting, but without a strong business behind it, that payout can vanish overnight. Another cool aspect of dropping stock prices means that your dividend reinvestment buys even more shares, so your snowball of income grows faster. Thus, in down markets, your income can grow faster, which is cool, and in sideways markets, you're often still seeing your income trend up, even if your portfolio is going nowhere. And in up markets, you're getting stock appreciation and probably more income as well. Basically, you can do decently in all markets, which is another reason why dividend investing is often less stressful, at least compared to buy low, sell high investors who often stress when markets are crashing or going sideways for a long time. Now, to be clear, total return matters, and it matters a lot, to quote Chuck Carnival, but those dividends also matter because they're the part of your return that you can actually count on hitting your account, regardless of where the market is trading. Another reason blue chip dividend stocks can feel less stressful is that they often move around less than the overall market. I mean, since they're large, established businesses with reliable earnings and strong balance sheets, their prices often move less than the smaller or more speculative names in the market. For reference, my portfolio's beta is 0.66, which means it's about 1/3 less volatile than the market, which has a beta of 1. So if the market drops 10%, I'd guess my portfolio might drop around 6 or 7%. It's not a guarantee since beta is just an average based on past performance, but it gives a rough sense of how my portfolio tends to be less dramatic than the market. Of course, there's a trade-off with a low beta, which is that you tend to lag in strong up markets. So if the market rises 10%, I'd probably gain around 6 or 7% on average, roughly speaking. My individual stocks can always do much better or worse, but beta can give at least a rough idea of what I might expect overall. That said, beta is based on past performance, so it's not a perfect prediction. Like certain holdings or sectors might outperform or underperform regardless of beta. And I'd lean toward higher beta tickers, generally speaking, for someone who wants to focus on capital appreciation. You just want to make sure that those higher beta tickers also have solid growth opportunities that you believe in, because you can't just look at beta in isolation. And speaking of my portfolio, let's jump into my Fidelity account so you can see all my tickers. So I took this screenshot after market close on September 6th. In total, my 3 accounts add up to $3.493 million worth of tickers, with $1.5 million in my retirement account, $1.75 million in my taxable account, and $228K in my wife's retirement rollover account I manage. This also says that I'm about 93% domestic US stocks. Moving on, we come to my IRA, which is sorted alphabetically by ticker, and this is page 1 of 2. I'm not going to call out each ticker right now since I'll cover them all together when I show you my spreadsheet tool. For now, I just wanted to share this for anyone who might question whether my accounts are legit. Moving on, we come to my second page of tickers in my IRA, and you can see how the total adds up to $1.51 million of tickers that Fidelity estimates yields a little over $68,000 of divvies a year. Moving on, we see this is page 1 of 2 of my taxable account. And then this is page 2, where the total adds up to $1.754 million, which yields almost $74,000 a year. Next up is the rollover account worth $228K, and which yields a little over $8,000 a year, so in total I'm making about $150K annually. And then this is Fidelity's total returns section, and it says my portfolio's total returns from February 8th, 2021, when I transferred there from E-Trade, until now have been about 70%. Fidelity seemingly estimates total returns for specific full years, so these index returns are listed as dashes. But what we can do is go on Seeking Alpha, which I'm an affiliate of, and put in VTI and VU with the starting date of February of 2021 until now. What we see is that I've been beating the overall US stock market represented as VTI as it's returned 65%, but I've been underperforming the SP 500 as it returns 77%. Not bad for a conservative dividend portfolio in a bull market. My longtime subscribers have seen my portfolio when I was at E-Trade, so feel free to look back at my older videos if you want more details on things. But far more important than my portfolio is a lesson you should take away from all this, which is that the most essential investment you can ever make is in yourself, especially in your health. Without health, no amount of money or financial security really matters. So make time to move your body. Go to the gym, go for walks, do cardio and lift weights. Eat whole foods that fuel you, stay hydrated, and do your best to get enough sleep. Don't put off investing until the perfect time, and don't put off taking care of your health until life feels easier. The perfect time is now. Try to avoid the traps that set you back, like drinking too much, smoking, or letting exercise slide for months at a time. If you stumble, remind yourself why you started and keep moving forward. Guard against becoming sluggish and tired, and if that happens, use your why as motivation to eat better and get active again. Think of your health the same way you think of investing. Small and consistent habits compound over time, and the earlier you start and the longer you stick with it, the bigger the payoff down the road. Preventing health problems is always easier and cheaper than trying to fix them after the damage is done. And just like with money, discipline and consistency create the best long-term results. I've had a bunch of health issues I inherited from my dad, and they didn't hit me until I was in my 30s. And even though I worked out and ate right my whole life, I learned that sometimes bad things just happen. That's also true with your portfolio. You can do everything right and still get unlucky. Like, I can't tell you how many times I've sold something only to see the stock finally shoot up right afterwards. Or bought something only to see it crash the next week. And that's just part of the game that tries to knock you off. But if you don't quit, if you keep pushing both physically and financially, you give yourself a much better chance of enjoying your future life. And that reminds me of a crazy example of not quitting, which was Kobe Bryant back in 2013 when he was up against the Golden State Warriors and tore his Achilles tendon. Watch this 20-second clip of what happened.
Since then, though, 0 for 6. As he has it, spinning, in trouble. Oh, and he's limping, he's hurting. Kobe's hurting. And I don't know if he's going to be able to continue. This might be that same knee that he hurt.
No, this is
it
seems like it's
different?
no, this is the right foot, or the right leg. I mean, the injury a minute ago was to his...
But the part that really stood out for me was what Kobe wrote on his social media account that night after the game was over. He said, and I quote, "This is such BS. All the training and sacrifice just flew out the window with one step that I've done millions of times. The frustration is unbearable. The anger is rage. Why the hell did this happen? Makes no damn sense. Now I'm supposed to come back from this and be the same player or better at 35? How in the world am I supposed to do that? I have no clue. Do I have the consistent will to overcome this thing? Maybe I should break out the rocking chair and reminisce on the career that was. Maybe this is how my book ends. Maybe Father Time has defeated me. Then again, maybe not. It's 3:30 a.m., my foot feels like dead weight, my head is spinning from the pain meds, and I'm wide awake. Forgive my venting, but what's the purpose of social media if I don't bring it to you real? Feels good to vent, let it out. To feel as if this is the worst thing ever. Because after all the venting, a real perspective sets in. There are far greater issues and challenges in the world than a torn Achilles. Stop feeling sorry for yourself, find the silver lining, and get to work with the same belief, same drive, and same conviction as ever. One day the beginning of a new career journey will commence. Today is not that day. If you see me in a fight with a bear, pray for the bear. I've always loved that quote. That's Mamba mentality. We don't quit, we don't cower, we don't run. We endure and conquer, end quote. So Kobe epitomizes the lesson that you can achieve whatever you set your mind to if you don't quit and you keep pushing forward. Don't waste time pitying your situation, instead take action to make things better. Everyone has setbacks and yeah, sometimes they'll hurt. But don't let that beat you or define you. Be defined by the actions you take regardless of the crap that's thrown your way, and never quit. The closest I came to quitting investing was after the dot-com crash. My portfolio fell even more than the Nasdaq did because I was invested mostly in speculative tech stocks. For reference, the Nasdaq Composite peaked at 5048 in March of 2000, but by October of 2002, it had fallen to 1114. That's a drop of about 78% from peak to trough. So imagine if you had a $100,000 portfolio in 1 year, and a couple of years later your portfolio was at 22 grand. Would you quit investing? Multiple of my friends did, even though their portfolios also shot up to get that high. But that's the roller coaster the market can be. And then it took the Nasdaq more than 15 years to get back to its 2000 high, as it only finally surpassed its old peak in April of 2015. That whole experience showed me the value of my boring dividend stocks, as they held up much better and they kept paying me income. Bottom line, I didn't quit investing, even though quitting seemed quite appealing. But the fact that I kept driving my work income into my stocks is why I then got to experience decades of compounding growth from that time forward. So these days when I look at my portfolio, I've already come to terms with the possibility that it could fall by 50% or even more, and I'm confident my income would also drop, but I'd wager it would drop by a lot less than 50%, even in extreme scenarios. So if you take it in the shorts and you need to take a break from investing for a while, then do that. Just don't stay away too long, as I'm pretty sure your future self will thank you for staying in the game. Take a listen to this 60-second clip that my wife recently shared with me, which helps solidify what I'm talking about.
This study will blow your mind. There was a study that was done on rats in the 1950s where they dropped rats into water with no way of getting out. And they swam around looking for a way to escape for about 15 minutes before they started to give up and drowned. And then the researchers took them out and saved them before they died. A couple days later, they put them back in the water again. And you want to know what happened? This time they swam for 60 hours. They went from 15 minutes to 60 hours. Why is that? Did they magically get stronger? No. The difference is that this time they believed that they would get out. This wasn't a test on strength. It was a test on belief, because this time the rats believed that they would get out. So they just kept going. This is how the human mind works. If you don't believe in yourself and believe that the life that you want is possible, you will quit too soon. But if you can get your brain and your body to truly believe that you will achieve what it is that you want, then you will never give up. And with that mindset, you can achieve anything that you want.
So don't give up, and realize that even if you invest in a perfect way, you'll still sometimes lose. And that reminds me of another key lesson, which is that dividends are not guaranteed. No asset is guaranteed, even though some come close, though I've seen that good companies with solid track records of paying increasing dividends often have a strong likelihood of continuing to pay them and increase them as time goes on. Of course, if a company flounders, either due to their own mistakes or perhaps due to the industry they're in, then there's a higher chance that their dividends can be cut. But even with setbacks, like the pandemic, my longtime viewers have seen how things have been progressing for me, and how in the last 5 to 6 years I've made about 600 grand in dividends and distributions, most of which I've spent on bills. Okay, now let's jump into my dividend spreadsheet tool to see a better view of my portfolio, along with some cool charts and graphs. So I've sorted this starting with my largest position on top, and this is page 1 of 3. Surprising to me is that Altria, ticker MO, is my number 1 position, but that's because it shot up so much this year. Like its total return is 30% year to date, which is almost triple what the SP 500 has done. I've got about 250 grand of Altria, and it generates about 16 grand in divvies per year. And note, I strongly discourage anyone out there to copy my investments. Instead, I recommend you research things and then invest in a way that aligns to your goals, risk tolerances, and timeframes. Okay, up next is Realty Income, the monthly payer, which has struggled as of late due to interest rates and such, and I have a 225 grand position in it, and it generates a little over $1,000 a month for me. And in fact, after I worked on this part of the video, Realty Income announced a small 0.2% increase, and they normally do multiple smaller ones and one larger one each year. So my O income is now officially a tad higher than what I'm showing right here. Up next is a dividend ETF in SCHD, and I've got 223 grand of it, and it yields about $8,200 a year. Then I've got AbbVie at 198 grand, yielding $6,100 a year. Then a super low yielder in Microsoft at 185 grand, yielding $1,200 a year. Then the old classic J&J, which has been beaten down mostly due to litigation concerns, and I have 172k worth, yielding $5 grand a year. Next up is an international ticker I own in British American Tobacco, which I have 158 grand worth, and which is yielding $9,100 a year. BTI is another sin stock that has blown up this year, delivering about a 60% return versus the 11% of the SP 500. I knew it was underpriced, but man, I didn't think it would move like that. Let's take a quick detour and share a new lesson I learned this year about BTI, which can give you some insights into international stock investing. So this is a screenshot I took from February of this year, and you can see it says British American Tobacco, level 2 ADR, each rep 1 ORD, GBP 0.25, BNY, fund, posted a distribution, and I wasn't sure what everything in that stood for, so I dug into it. ADR stands for American Depository Receipt. They're a way for U.S. investors to invest in foreign companies on U.S. stock exchanges without having to deal with foreign exchanges, currencies, or the regulations. ADRs can be level 1, 2, or 3, where the higher the level, the more stringent the SEC regulations. Level 1s are the most basic type of ADR, traded on the over-the-counter or OTC market, and they have the least regulatory oversight, and thus I consider them riskier. Level 2 ADRs are listed on a U.S. stock exchange like the NYSE, and they comply with more stringent SEC regulations compared to Level 1 ADRs, meaning they have more visibility and stricter reporting standards. Level 3 ADRs have names you probably recognize like Alibaba, Taiwan Semiconductor, and Unilever. I'd personally probably shy away from Level 1s in most situations. Okay, the next part says each rep 1 ORD GBP 0.25 means each ADR represents one ordinary share of British American Tobacco, and the nominal value of each ordinary share is 0.25 Great British Pounds, aka pound sterling, aka pound, though that's more of a formal value than the actual market price. So to get more specific, it's saying that each ordinary share has a par value of GBP 0.25 British pounds. The par value is mostly a formality, especially in modern finance, and has little practical significance for investors. And the last part of the screenshot says, BNY Fund posted a distribution. BNY stands for Bank of New York Mellon, but I learned that Citibank was actually the custodian. So I dug into that and then found this on the Citibank website. It said that Citibank in London is the successor depository to Bank of New York Mellon as of 2008. So it looks like the BNY in the distribution is a legacy attribution that is actually no longer correct, but no one has changed it. At least that's my guess. So to summarize, each rep 1 ORD GBP 0.25 just clarifies that the custodian has processed a dividend payment to my account. The dividend amount I receive will depend on how many ADRs I own and the current dividend rate of BTI, possibly adjusted for any withholding taxes or currency conversion from GBP to USD. And in this case, the dividend distribution from BTI is also known as ticker BATS on the London Stock Exchange, or LSE. When comparing BATS on the LSE to BTI on the NYSE, you'll need to do various currency conversions and such if you want to compare the prices. So I found that kinda neat. Okay, back to my portfolio. Up next is my first covered call ETF in Devo, and it generates about $7 grand a year. Overall, about 14% of my portfolio is in covered call ETFs, and each one has its own risks to be aware of. I'd expect my covered call income ETFs to probably take a material hit down if the market has a big drop, but I'd also expect most or all of my other tickers to keep paying out as before. And note, I don't recommend these sorts of income ETFs unless you're in retirement or really need the passive income and you are okay with the trade-offs and risks they represent. After Devo, I have an MLP and EPD, then 2 more CC ETFs in JEPQ and GPIQ, and then Goldman Sachs and Duke Energy. Moving on to page 2, we see I have McDonald's at about 129 grand of it, and it yields about $2,900 a year. Then Procter & Gamble, Coca-Cola, Pepsi, Philip Morris, Southern Company, ExxonMobil, Kimberly-Clark, Chevron, Apple, Caterpillar, Travelers, Home Depot, an International Dividend Income ETF and IDVO, and finally Starbucks. In total, I have 45,700 shares of tickers, and on the day I took this screenshot, my portfolio was down 0.19%, which means it fell about $6,500, taking my total to be about $3.49 million. My portfolio dynamically updates based on changing currency conditions and some other factors, so sometimes you can see minor disparities between screenshots that I've taken in different moments. In total, I make a bit over 150 grand in passive income a year, and my portfolio's average weighted yield is 4.3%, and its dividend CAGR is 5.3%. Moving on, we come to page 1 of 2 in a section I called the Dividend Calendar View. It shows the last 6 months of dividend income I've gotten in the first 6 columns after the ticker, and then this month's income is in the green column in the middle, and then future months of dividends are in the columns to the right. So like in April, MO paid me $3,875 of dividends, then again in July. Then next month it bumps up to $4,027 thanks to a dividend hike they just announced, and I should see that same increased payout again in January of 2026. That's one thing I love about solid dividend payers, is that they tend to keep growing their payouts over time. Another thing you might notice is that O, Devo, and JEPQ are all monthly payers on this page 1, and I recently established a new position by moving some stock profits into GPIQ, which is why its monthly payment starts this month in September and continues out into the future. Moving on, we come to page 2 of my dividend calendar view. On the bottom of each month of payouts, you can see the totals I got. So in March, I got $13,200 in dividend distributions, then $9.5K in April, $11.4K in May, $13.8K in June, $9.5K in July, $11.4K in August, and then I'm scheduled to get $12K this month, then $10.8K, $12.4K, $14K, $11.1K, and $12.4K in February of 2026. If you look more closely at the numbers, you'll see that ETFs have the most volatility, whereas my normal blue chip tickers tend to just go sideways and up. Also check out Procter & Gamble in the top row, which has been paying me $813 a quarter. I point that out because now I want to look at this view of my historical dividend income going back 5 years, i.e. when I started this new version of my spreadsheet. So back in February of 2020, right before the pandemic hit, I got a quarterly payout from Procter & Gamble for $564. Then the next quarter in May, my payout was $601 because they did a dividend hike and because my divvy reinvestment plan was on back then. In August, my PG drip took me up to $606, then up to $609 in November. Then I turned off my drip and started living on my dividends, so my February of 2021 PG payout was still $609. Then they did a dividend hike, so my May payout was $669. August stayed at $669, as did November's payout, as was February's of 2022. Then they did a dividend hike, so my May of 2022 payout went up to $703. It stayed there for a year until May of 2023, when my payout went up to $724 a quarter. Then again it stayed there for a year until May of 2024, when my payout went up to $775 a quarter. Once again it stayed there for a year until May of this year, when my payout went up to $813. And that's the power of a good dividend stock, which is continually making more profits and then rewarding their shareholders. They often keep raising their payout, usually more than inflation, and then you as an owner keep getting more cash. You gotta love it. I believe I'll see a hike out of PM this month, as well as one from Microsoft, and I expect one soon from AbbVie, McDonald's, and some others. And then here's a dividend income chart which shows my dividend income month over month since I started this new spreadsheet, and you can see how it's been trending up. It's still early in September when I'm working on this, so this month's payout is small so far, but I should end at 12 grand once the month is complete, so it'll hit the black line. Moving on, this is my portfolio value by sector, and overall I'm lightest in industrials and financials. And here's my passive income by sector, and again you can see how my industrials and financials are my smallest ones. And then this is my estimated dividend income as the years go forward, assuming my tickers continue to hike as they historically have. The top row is the no reinvestment line, which is basically what I'm doing these days since I only reinvest some of my ETFs back into themselves, and then I use all the rest of my divvies on expenses. Then the bottom row is the reinvestment estimates, so I'll probably end up somewhere between those two rows if all goes well. And as an example, this estimates that 6 years from now, if I was spending all my divvies, then I'd be making about $204 grand a year, though if I'd been reinvesting all my divvies, I'd pull in about $258 grand annually. This also shows that on average I make about $12,500 a month in passive income, which is about $28.90 a week or $411 a day or $17.16 an hour every hour, 24/7 by 365. I gotta tell you, it's really cool to be playing video games or going on a vacation or even snoozing, knowing that your investments are pushing cash into your bank account, because I've configured Fidelity to do just that. It feels like I have a magical ATM machine which just keeps filling up with cash. But it's not magic, it's just my companies sharing their profits with me. Now, one risk area I should call out are my single company tickers I'm invested in. And that leads to an important lesson to share, which is that I'd expect that most people who invest in single stocks will underperform the broader market over the long run, as the study confirms. Thus, if you have a decade or more before you retire, then my recommendation is to simply go with VU or VTI or something like that, and then only invest in individual stocks if your eyes are wide open to the risks you're taking on. Yes, you can sometimes do great with single stocks, but it's harder, and harder isn't always better. That's what she never said. So not only am I immature, but I've also been more of an individual stock guy than an ETF guy over my 3 decades of investing. I've always been okay to take on single stock risk, and I enjoy researching stocks. I've found that dividend growth stocks tend to perform better in strong markets, on average, while higher yield dividend stocks often hold up better when things turn south. But as you just saw with MO and BTI, sometimes high yield can do well in bull markets as well. Anyway, if you choose to invest in single stocks, then make sure you learn how to calculate intrinsic value so you can better judge whether something is cheap or expensive. I recommend getting a subscription to FastGraphs, which I'm an affiliate of, because it gives you clear and easy to understand charts that make the valuation process a lot simpler. But tools and methods aside, another lesson worth reflecting on is that there are many different ways to invest. My goal is not to get you to only focus on quality dividend companies, but to encourage you to invest in a way that makes sense for you. I want everyone to learn about how to grow their wealth and/or passive income, but to weed out any noise that might not make sense to them. Like, I've had people who tell me that dividends are meaningless, or that 401ks are a scam, or that homes are terrible investments, and my personal experiences disagree with each of those points. I mean, my 401ks always had matching contributions that helped push my retirement account over $1 million, and there's no way I'd be where I am today without that free money from my employer. And my houses have been great investments as well. I made sure to buy each one at a good price, and I got to enjoy the pride of ownership and living in them, and then I sold each of them for great profits. And clearly I feel that dividends matter because my entire channel is dedicated to them. Regardless, I don't care who invests like I do, I just want people to invest with their eyes wide open. Whether that's crypto or real estate or commodities or whatever floats your boat. Everyone is unique, even dividend investors. Like some divvy guys focus on the highest dividend CAGRs, which usually means the lowest starting yields. Some like to focus on higher starting yields with lower dividend CAGRs. There are an infinite number of ways to invest, and no one can predict how the future will go. I mean, is the next 30 years going to be as strong as the last 30? I obviously can't answer that accurately. I can say that some experts warn that AI and robotics automation could displace as much as half of all jobs over the next 20 years, and under extreme scenarios, that number could climb much higher. But I'm guessing that jobs like plumbers or electricians will likely be harder to replace, while many white-collar computer-based roles are more at risk of going first. But the question I have is, how does the world work in a post-labor economy? I mean, if the majority of people lose their jobs, how are they supposed to get by? Please leave me a comment and tell me what you think is going to happen in the next 20-ish years, because I'm really curious where people's minds are. And while employment is the more important question, I also wonder who's going to be buying what our companies sell if folks aren't working. Plus, will the US economy still be number 1 in terms of gross domestic product, or will China overtake us? And if so, how would that impact things? Heck, I just heard a crazy stat that said that computer science majors graduating today have a lower employment rate than art history majors. I never would have guessed that in a million years. I actually have a relative who's getting her degree from art school, so I guess that's good news for her. But man, I hope we don't have massive job loss as time goes on. That being said, losing a job is one of the big lessons why I invest. That's part of why I like passive dividend income so much, because it can cushion the blow when your job income disappears. Getting fired can be a scary thing, like if you're the primary breadwinner for a family. Honestly, it can be scary no matter what, especially if you don't have a support system of parents or relatives who can help. I remember early in my career calling up my dad when I was worried about losing a job. I was hoping he would say something like, "Don't worry, if everything falls apart, you can always count on me." Instead, he just said, "Yeah, life is hard sometimes, you'll figure it out." The upside of that tough love was that it lit a fire under me to succeed, and investing became one of the main ways I figured out how to do that. It's also another reason why I became motivated to leave my kids a dividend portfolio when I'm gone, because I don't want them to face the same level of angst I went through, even if in the long run it did make me stronger. That mindset shaped how I thought about money, not just for my kids, but also for myself. I always knew I could sell stock to get by if needed, though I tried to avoid doing that. So having the ability to generate income from your assets without selling, especially when you've lost a job, is massively important. Yes, you want an emergency fund, but I think having productive cash flowing assets is just awesome. You'll find that investing transforms your effort and discipline today and turns it into opportunities and more financial security for tomorrow. So investing isn't just about growing your net worth, it's about building resilience and control over time and over your time. And the unfortunate reality is that most folks can't afford an unexpected $1,000 expense, but if you can invest, then you're giving yourself the chance to break out of that cycle. Every dollar you put to work becomes a little guardrail against life's surprises, a little step toward financial freedom, and over time those steps can compound into the financial stability most folks only dream of. So treat your investing like it's a tax you have to pay and make it a priority. And here's the thing, no matter how much resilience you build personally, you also have to think about the bigger picture. If people are losing jobs and economies are shifting, then we have to ask not just how to invest, but where to invest. That brings me to another lesson I think is becoming more important over time, which is to start thinking more internationally. I mean, for decades the US has been the obvious place to focus, and it still is my main focus today. But the winds of change in recent years have made me feel it's prudent to diversify more globally. Now, most of my US stocks do generate meaningful international revenue, but I still think it's worth broadening my ownership. That's why I recently added the International Income ETF IDVO, as it holds companies in China, Japan, Brazil, Canada, Germany, Taiwan, and more. Maybe consider non-covered call international ETFs from Vanguard or Schwab, as they're brokers with strong names. I'll probably still be 90% in the US, but slowly over time I'd like to continue to grow my international exposure. Moving on, the final lesson I want to leave you with is this. Don't think you need a massive dividend portfolio to do well. The hardest part is to begin, and the next hardest part is to keep investing. You don't need dividends to cover all your expenses, but maybe covering some might make sense. Whatever you do, look into opening a Roth account if you meet the requirements, transferring some cash into it, and then invest in some good tickers using that cash. Then just keep at it over time. Consistency beats complexity, and the earlier you start, the better off you'll probably be. It really comes down to building the habit and letting time do the heavy lifting. And with that, I ask you to please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my channel. Now, before I shout out some of my subscribers, I want to do a call out to Financial Modeling Prep, aka FMP, the company I'm using to get accurate near real-time stock data into my dividend spreadsheet tool. FMP has historical prices, fundamental data, insider transactions, and much more, all of which goes back 30 years in history. They have one of the most generous API rate limits out there, with various option plans depending on your needs. They provide some niche data packages like earnings call transcripts and 13F institutional ownership that other providers I looked at didn't seem to have. Plus, they do things like their dividend information accounts for stock splits, so you don't have to separately retrieve split data to calculate dividend CAGRs. I've included my affiliate link in the description of this video in case you're looking to get great market data into your software, and my link should get you a discount off their prices. Okay, now I'd like to do some shoutouts to my subscribers, starting with my Gold Star channel members, i.e. the ones that have been members for a year or more. So thank you Brett Cherry, Aaron, Scott Goodwin, Steve Doxa, and Keithman5000. Now I'd like to shout out my newest Patreon king, so thank you Marzil Crypto for signing up, which gives him access to everything my Patreon aristocrats get, as well as he gets to have a private 30-minute voice chat to talk about whatever he likes. My upper tier Patreon slots are normally sold out, so I apologize to those of you who are trying to snag a seat. Moving on, now I'd like to show my gratitude to subscribers who left me really nice comments, so I'm going to shout out 10 who've done just that. So thank yous go out to JC Zayas35, International Dividend, The Real Jordan, Mikey Man 1974, Am Mart 5240, then multiple from P. Dureska 7814, multiple from Drifting into Retirement, multiple from Josh Mallet 9452, multiple from Walter Ramirez 3287, and multiple from Eingram 141. Thanks folks, I really appreciate it. Now I'll ask you to consider clicking on my Amazon affiliate link in the description of this video and then go shopping online. As an Amazon associate, I earn from qualifying purchases, which means I get a small commission after you click on my link and then you shop for whatever you need, and it doesn't even impact the prices you pay. I'd also like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'll also like to pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.